In our previous session, we discussed bond yield. Today, we are going to explore a very crucial and a new topic, and that is valuation of shares. In this unit, we will explore the basic principles of share valuation, different methods used to value shares such as dividend discount models, earnings based models, and market based models, and the factors influencing share valuation, including the growth rates, market trends, and risk. Imagine you are an investor and you are considering buying shares in a company. You know the market price of the share, but how do you determine whether it's worth that price? How do you assess whether you are paying too much or if it's a great investment opportunity? That's where the concept of share valuation comes into play. At the end of this topic, you will be able to explain the foundational concepts of share valuation. You'll be able to classify the shares. You'll also be able to explain the preference shares. You'll be able to determine intrinsic value of preference shares. Valuation of shares is a critical process for investors, companies, and financial analysts. It is the method used to determine the true or intrinsic value of a company's shares rather than relying solely on the market price, which may fluctuate based on factors like speculation, market trends, or short-term news. Share valuation refers to the process of determining the worth of a company's stock based on the financial performance, future earnings potential, and market conditions. This involves various methods, from simple approaches like dividend discount models to more complex ones like price to earnings ratio or free cash flow analysis. Let's begin by understanding one of the most crucial components of the stock ownership: dividends. When you invest in a company by purchasing its shares, you essentially become a part owner of that company. As a reward for investing, companies often share a portion of their profits with their shareholders. This distribution of profits is what we call a dividend. A dividend is a payment made by a company to its shareholders, usually out of its profits or reserves. It is a tangible way of sharing the company's financial success with its investors. Dividends can be in the form of cash dividends or stock dividends. Cash dividends are the direct payments to the shareholders, often deposited in their bank accounts. Stock dividends are the additional shares of the company issued to the shareholders instead of a cash. When we think of claims, we think of the rights or entitlements that different stakeholders have over a company's assets and earnings. These claims arise because businesses are financed by a combination of debt, equity, and other instruments. Essentially, claims determine who gets what in terms of financial benefits and in what order, especially during critical events like liquidation or profit distribution. Debt claims that are held by creditors or lenders, and equity claims that are held by shareholders. Let's now focus on redemption. Redemption plays a significant role in determining the intrinsic value of certain types of securities, particularly preferred shares and bonds. But what exactly is redemption, and why is it significant? Redemption refers to the process of by which a company repays or buys back securities such as preferred shares or bonds from its investors. These securities are generally issued with a specific maturity date or redemption schedule, at which point the company redeems the securities at the pre-agreed value, typically the face or par value. For company, redemption has an impact on its cash flow. Redemption results in a fixed outflow of cash for the company. This influences the net cash available for operations or dividends. For investors, knowing the redemption schedule allows investors to estimate when and how they will recover their capital, which helps in calculating the present value of expected returns. Another key concept in valuation is conversion. Conversion refers to the process of exchanging one type of security for another, typically at a predetermined rate. Conversion provides a unique mechanism for investors to benefit from both fixed income security features and the growth potential of equity shares. It plays a critical role in valuation as it affects both the security intrinsic value and the overall share capital structure of the company. Moving ahead in the process of understanding share valuation, let us now explore the types of shares that exist within a company's financial structure. Shares represents units of ownership in a company, and they are classified into primarily two categories: equity shares and preference shares. Each type comes with the distinct characteristics, roles, and implications for both the company and the investor. Understanding the types of shares is essential for evaluating the value accurately. Equity shares offer growth potential but come with a higher risk, while preference shares provide stability and lower risk with fixed returns. Let us now move ahead and discuss each of these types along with their valuation. We will start with the preference shares. Preference shares are a form of share capital that gives shareholders preferential treatment in terms of dividends and repayment in case of liquidation. These shares offer a fixed return, making them less volatile than equity shares. Let us quickly discuss the main characteristics of these shares. First is fixed dividends, which makes them a predictable source of income. Secondly, preference shares get priority in payments. This means are paid before equity shareholders, may it be the case of dividends or in the event of liquidation. Also, unlike equity shares, preference shares generally do not provide voting rights, limiting their influence on the company's decisions. Lastly, preference shares are considered less risky compared to equity shares due to the fixed dividend and priority in payments. Now that we understand the preference shares, let us continue with the valuation aspect. A point to note here is that the preference shares represent a hybrid financial instrument that combines some features of the debt and equity. So like bonds, preference shares provide a fixed rate of dividend to their holders, making them less risky than equity shares. To value preference shares, we need to calculate the present value of two cash flows. First, the fixed dividends, which is DP, over the life of the share. The redemption value, which is second, often termed as PN at the end of the maturity period. Mathematically, this can be expressed as P naught is equals to DP divided by inside the bracket 1 plus KP to the power n, close the bracket, plus Pn divided by 1 plus Kp to the power n. Alternatively, we can simplify this formula using the present value factors as P naught is equals to dP into PVIFA inside the bracket Kpn plus Pn into PVIF inside the bracket Kp, n. Here P naught is equals to price of the share, dP is equals to dividend on preference shares, Kp required rate of return on preference shares, and N is equals to number of years to maturity. Let us take a quick example to understand the calculation better. Suppose you have to determine the intrinsic value of preference shares. It is a 10% preference shares having a face value of 100 rupees. The required rate of return is 8% and maturity period is 5 years. What will you do? The solution is simple. To apply the formula, you need four things: price of the shares, dividend on preference shares, required rate of return on preference shares, and the number of years to maturity. We have all the information except the annual dividend amount. So let us first calculate that. Annual dividend amount will be the face value of the dividend multiplied by the rate of dividend. This gives us face value of rupees 100 multiplied by 10% dividend rate, which comes to an annual dividend of rupees 10. Let us now substitute these values in the formula. Here we will use present value factors formula. You can use the alternate approach also as taught earlier. Substituting the values in formula, we get P naught is equals to 10 into PVIFA inside the bracket 8%, 5, close the bracket, plus 100 into PVIF inside the bracket 8%, 5. Now PVIFA value for 8% interest for 5 years is 3.993 and PVIF value for the same is 0.681. Putting these value, we get P naught is equals to 10 into 3.993 plus 100 into 0.681. On simplification, we get the intrinsic value of this preference shares as rupees 108.03, which is higher than its face value. In this session, we have learned the key concepts of share valuation, including dividends, claims conversion, and redemption. We have also learned the two types of shares, equity shares and preference shares. We have learned the key features of preference shares like fixed dividend, low risk, preferential payments, and no voting rights. We have learned two formulas for valuing preference shares. That's all for today. Thank you and happy learning.